Welcome to this quarterly update for the Schroder Absolute Return Income Fund and PAYS, which invests into the Absolute Return Income Fund. So what I discussed today about the Absolute Return Income Fund, the same applies for our ETF, our active ETF PAYS. What we're going to do today is run through recent performance, how we achieve that performance, what we're thinking about going forward, and how we're positioning for the portfolio for that forward-looking view. So how did we go in terms of performance? So the Absolute Return Income Fund and PAYS delivered approximately 6.2% for the year to June 2024. That was after fees. So that was 200 basis points or 2% over the Reserve Bank cash rate, which is right on our target return for this strategy. So how did we do that? Well, mostly we were quite optimistic about the global economy. And so our strategy was to really lean into credit risk over the year and target via credit risk a portfolio yield of approximately 1% over that RBA cash rate, and then rely on capital gains through either our interest rate exposures or our credit exposures to capture that additional 1% gain over the year, which we did. When we look at what happened over the year, we can see that the preference for credit over rates was the primary driver of our returns. On this chart we're looking at now, we can see on the left-hand side the yield of the Australian 3-year bond rate over the year and the cash rate. And what you'll see, the cash rate's in green, and what you'll see is the bond rate from about December onwards was well below the cash rate, delivering you about 60 basis points less yield than the cash rate. So investing in that Aussie bond rate, that 3-year bond rate, won't get you your target return of 2% over the cash rate. What you're relying on is some capital gains to flow through. And as you'll see, the bars on that chart, that's our exposure to that 3-year bond return or 3-year bond yield. And as you can see, as the gap between the Australian cash rate and the 3-year bond yield widened, our exposure reduced. So we didn't want exposure to 3-year bond rates or Australian bond rates when the yields were so far below the cash rate. And why was that? We didn't think the Reserve Bank was able to cut rates. So we didn't think that green line, that RBA cash rate line, would be lower during the year by the RBA delivering rate cuts through the year. And that's because we were worried about inflation being higher through the year and the RBA not being able to cut rates. So what we wanted to do to capture that excess return over cash is expose the portfolio more to credit risk. We were quite optimistic on the global economy, and that's good for lending to corporates and consumers because their ability to pay is much better when the global economy's growing. So at the chart on the right, what we've got is the spread, the extra yield you receive by investing in corporate securities and consumer debt relative to the government debt. You can see the spread, both the green line and blue line, gradually decline over the year. And the blue bars are our exposure to those asset classes. And you can see that, and at times they're up around 75% of our portfolio was in credit. While those lines decline over time, what that means is we're capturing capital gains to the portfolio. So in the case of global securitized credit, the spread compressed by about 50% from over 300 to 150 over the year. So this delivered us with some capital gains over the year. And the other line, the blue line, is Australian BBB corporates and subordinated debt paper. And this also performed really well with spreads declining from over 250 to under 200 over the year, delivering capital gains. So by reducing interest rate risk in the portfolios over the year, by having lower duration and putting more of our risk in credit, we're able to put our risk in the right part of the markets to capture those capital gains. So credit risk was provided the bulk of our returns or excess returns over the period. So what are we looking for going forward? Well, we're still pretty optimistic about the global economy. We think the central banks are at the start of a global easing cycle. We're seeing central banks cut rates already. This is good for consumers and corporates paying ability to pay on their debt. So most of the models we look at are looking at an uptick in manufacturing, and not just in the US but now in Europe. And this is an inventory cycle that's rebuilding. So that means it gives us a floor for GDP, it makes us more optimistic on growth going forward. A number of our models are pointing this way, and so it's going to be supported by inventory cycle plus central banks being able to ease monetary policy, which supports that cycle. So what's the story in Australia? Well, unfortunately for Australia, we're about 6 months to a year behind the rest of the world in terms of getting inflation down. So what we're looking on this chart is tradables or goods inflation on the left and services or non-tradables inflation on the right. And what you can see is most of the hard work has been done by goods inflation declining, and that's declined to about 1% year on year. Most other developed market economies have got that into a negative territory. We're still positive. So we're still getting inflation in goods. So that looks to be bottoming though. Like it looks like the hard work's already done. It's going to further gains here is going to be difficult, particularly if the global economy is going to pick up. On the services side, we've got very sticky inflation, and it's flatlining at 5%, and it hasn't declined all year. So when we put those two together, we've got about a 4% inflation rate, and that's well above the RBA's target of 2.5%. So the clear risk here is the RBA may have to raise rates again, perhaps twice in the next 6 months. And that's, during a period where the global economy is re-accelerating. So that's clearly the risk on the rate side for Australia. And when we look at our portfolio in terms of rate risk and credit risk, what we'd want to do in that situation is keep our rate risk, our interest rate risk lower, but also what it does is it increases the risk of a recession in Australia. I'm not saying that there is going to be a recession in Australia, but higher interest rates now towards the end of the cycle when mortgage holders are already in stress does increase the potential for recession in Australia. And that has serious implications for our portfolio going forward. So when we look at credit and how we allocate to credit, one of the key metrics we use is valuations. And so what we're looking at this slide is different sectors of the credit market and where current yield spreads are relative to their own history. So this is the extra return I get when I invest in a corporate securities or a consumer security over a government security. And if it's in the red zone, which a lot of the current sectors are in the red zone, that means that they're expensive. So valuations are really high and the extra spread I'm getting is very low relative to it. So that increases the risk of holding those securities. As we move across the screen, we've got high yield. We're very much in the red zone, so credit spreads are very low and high yield. Then we've got emerging markets and Asian credit also in the red. But then we get across a bit further, we look at investment grade in the third block on the right, and Australian investment grade and European investment grade still look okay to hold. But this is valuation, so you've also got to look at the cycle. And if we're increasing recession risk in Australia, we do need extra credit risk premium to invest in those assets as a risk buffer for us. But European credit looks okay on a valuation basis, and Aussie credit, investment grade credit looks okay on a valuation basis. The last two is lending to consumers, either mortgage-backed securities or other asset-backed securities. Again, lending to consumers looks okay on a valuation basis. So valuations are okay in some sectors of the market, and we have been leaning to those sectors in the last 6 months and moving out of high yield credit and out of US investment grade credit. So when we look at the portfolio now, we can see on the left-hand side how we're currently allocated. And you can see there's a significant allocation to Australian credit, both investment grade and Australian high yielding credit. So somewhere close to 50% in those two categories. An allocation of around 8% to Australian mortgage-backed securities. There's a AAA mortgage-backed securities delivering about 100 over government bonds. And then in the yellow section, we've got allocations to global securities, including those global securitized credit I mentioned at the start, and some investment grade credit. If we think the risk to Australia is recession in Australia is increasing, we really need to start moving some of this credit exposure away from Australia and into the more global sectors, because we think the global economy is doing okay. So there will be a readjustment going forward as that risk increases going forward. We have started increasing our cash allocation. Last month, the cash allocation was 5%. It's now 16% of the month, and that's because we've started that process of reducing credit risk in the portfolio. The next part of that process will be reallocating that credit risk away from Australia and towards those more global sectors. On the right, you've got our key risk metrics of the portfolio. So we've got spread duration. This tells you how much credit risk we've got in the portfolio. At the end of May, we had over a 3-year credit duration. Now it's 2.5 because we've raised cash. Interest rate durations are around 2, just under 2 at the moment, slightly lower than the end of last month. If we think we're going into recession, after the Reserve Bank raises rates, we will extend the interest rate risk of the portfolio, because what will mean that increased recession risk will mean that any cuts to interest rates will be accelerated or come earlier than we currently anticipate. So we'd want to lock in higher yields earlier in that case. So we would anticipate increasing our interest rate mix into a rate increase by the Reserve Bank as the yields increase. So that's basically where we're at the moment. The portfolio did really well last year, delivering on its targets. We think there's some greater risk in Australian credit going forward because of the potential of the Australian Reserve Bank raise of rates here, increasing recession risk. So there is some rebalancing of the portfolio to be done. Thank you for your time.